topic actually, we're going to talk about multiples, meaning the multiples that you can expect for your agency, like the value of your agency. So that is the topic that everybody wants to talk about. No one wants to talk about what your EBITDA is or what your profitability is. They want to talk about these multiples that they hear about in the headlines. When thinking about either buying an agency or selling an agency. So we're going to tell you about those multiples and what they mean and what you should expect. So if you haven't noticed, there's a ton of activity in the marketplace. It continues to be strong, and that is driven by private equity being very interested in independent insurance agents. In fact, until our agencies do not have the retention rates that we do and that recurring revenue, private equity is going to continue to be interested in our agencies because it's so profitable and so predictable. But those headlines are not necessarily reflective of the entire marketplace. There's actually a ton of activity in the marketplace that gets announced, but there's even more activity that goes unannounced. So this came from a publication that looks at all of the insurance broker deals across North America. It comes from the S&P Global Market Intelligence. There are several different organizations that report the number of transactions, again, announced deals that occur in our country. And as you can see, the number of deals in 2021 far exceeded any of the previous years and any of the subsequent years. In 2021, it's important to note that that was the year that there was a looming tax change that predicted that maybe capital gains taxes were going to be impacted significantly. It's also in the middle of COVID, where there was a lot of uncertainty about how long it was going to last, how we were going to work, remote work, shifting of staff, etc. So because of those two things that were happening, there were a lot of agencies that rushed to the end of the year to get their sale of their agency done or the acquisition of an agency done that skewed those numbers. That fourth quarter was actually larger than any other quarter that has been recorded. And that really was what drove that year to surge. You can see since then, it's hovered in the 600 to 500 range. And believe me, there are plenty of transactions that never get reported. If an agency sells to another agency and it's a bank loan that's involved, you'll never see it reported in this. It's not a big broker's deal. But even more so, if an agency transitions internally, that's not reported anywhere as well. So it is estimated that the number of transactions that are reported is about roughly 20 to 30% of the total transactions that actually occur. And as being someone who's in this industry, there's tons of people talking about growing by acquisition and, same number of people talking about whether or not this might be their high and the time that they're thinking about selling. M&A announced deals are typically these announced brokers that occur. The biggest headline here is you can see the top buyers shift pretty significantly from year to year. You can see High Street Insurance was maybe the top buyer in 2021 with 56 acquisitions. And this, in 2023 and 2024 was number 6 or 7 on this list. So you can see that there are buyers that surge and then maybe plateau, and there's others that stay pretty consistent in the top 3. But it is important to know that each of these buyers, it is not a one size fits all. They're all looking for different things when they're on their buying strategy. Some are interested in agencies that have young owners that want to produce for the next 20 years. Others are interested in a blend of maybe owners that are at the end of their year and want to work a 3-year earnout and be done, and everything in between. So really important not to think of it as a one size fits all. These buyers have actually become pretty savvy with being able to relate to what independent agents actually want as they think about the future of their agency and potential sale opportunities. So these are the multiples that everybody wants to talk about. And honestly, you can find different statistics out there. This one happens to come from the Reggit Market Update in 2024, where it looks at the um, typical guaranteed price that agencies can command, and then what the additional earnout opportunity is, again, on these announced deals. Really important when these multiples are being published, you have to think of two things. Typically, they're talking about platform agencies north of 3 million in revenue or greater. And they're also talking about the total structure of the deal, which would include cash, stock, and an earnout. So don't think that these multiples are, if I have an agency that's $1 million in revenue, I can expect 12.5 times EBITDA, all cash up front for my agency. That's just not true. These are also completed by buyers that do not have to get a bank loan. If you have to get a bank loan, you have to stay below the debt to EBITDA ratio in order to allow that loan to cash flow. So whether you are a target of someone who is a PE buyer, or whether you're an agency that's trying to acquire and compete with a PE buyer, you have different constraints than someone who does not have to use a bank loan. And it's important to know that, because these headlines can be incredibly misleading and potentially not relate to your situation, and potentially also not relate if you are a buyer and you are one of the many people vying for a particular agency. It's not just money, but it's also the constraints of where you get the money and what's most important to that buyer that makes the difference. So again, but these are some of the multiples that they're seeing in the marketplace. There are some that say these multiples go up as high as 14, 15 times as well. So just take that with a grain of salt. There are plenty of reports out there that are saying, what is the condition of the market and is it going to continue? Lots of people want to know, when is the high? And the multiples have been absolutely increasing over time, and the market has stayed pretty active and solid, even though interest rates have risen, the hard market is here, the staffing changes, all of that to say many agencies that are well run and they are uh, well structured and are able to be transferable, meaning the predictability of the ongoing performance of that agency is strong, command strong multiples. If an agency can't say those things, and potentially their performance is going to be very hurt if an agency owner is no longer there, or they lose a key employee, or they lose a carrier, like whatever that is, if there's some uncertainty or risk inside the agency, they will not command the same multiples of other agencies that are strong. So in essence, in 2024, it was one of the most active years. It was actually the year where we started to see a flattening in the overall growth, but PE equity backed buyers dominated the announced deals, making up 78% of those announced deals, where public brokers and independent firms were made up the smaller, whatever, 20%, 30% of those deals. So private capital backed agents or buyers were the ones that dominated the market. In 2024, the valuations absolutely remained high. Even with the economic uncertainty, they remain strong, especially for small to mid-size agencies. There's more demand than supply. So even though interest rates rose, there was still more buyers available in the marketplace than sellers, making that demand keep those multiples up. The moment there's more sellers than there are buyers, you might see that flatten or soften a bit. And again, the interest rates rising actually caused two things to happen. Number one, due diligence was far more in depth for agencies. Because money became more expensive, they were actually digging into the numbers a lot deeper. But they also wanted to make sure that their recurring revenue is still there. So if you had a strong profitability, strong retention, a niche focus that allows um, some efficiency inside your agency and clean books, those agencies are 100% commanding the multiples of 2013 or 2023 and 2022. If that's not true in due diligence, that would cause that agency to be discounted because that creates some uncertainty. If their books aren't clean, if the retention rates aren't tight, if the profitability is questionable, the biggest thing, if the numbers don't tie and there's any kind of question mark, the buyer's going to discount it a bit in order to make sure they cover the risk in that deal. And so will the banks. So it on the whole, valuations have remained high, but there definitely seems to be a break between those that are high performing agencies and those that maybe be mediocre or low performing agencies in some of these areas, whereas they could command higher multiples before they can't in this environment. There's fewer buyers and more deals. So this actually looks at who the top 10 buyers were for 40% of the 2024 deals. They were Broad Street, Hub, InZone were the most active of the top buyers. And then you can see it starts to, everybody below that is somewhere between 2 to 3.5% of the market of the deals were spread across, several different 7 different players. But you can see Broad Street, InZone, and Hub were the largest players in 2024. It is important to note that in 2023, one of the biggest buyers didn't even make it to the top 10. And that's because these buyers have to recap or re-raise funds. And that particular buyer got caught in interest rates are rising. They weren't able to recap in time. So they basically took a hiatus of acquisitions until they could recap, which took them a little bit of time. So you can see changes in these buyers. And if you sold to a buyer that isn't able to recap right away and you wanted to exercise your stock, that could impact your investment and your overall value that you got out if your timing doesn't line up when they're able to recap. So they're just knowing and getting informed about the industry and what happens with multiples and what happens with buyers is really important if this is an area that you are contemplating for yourself. So we all know that organic growth has been fueled not only by writing new green business, but also by rate. And agencies averaged an 8.7% organic growth rate in 2024 that was down from 2023's 9.8%. We are projecting that 2025's overall growth will also be on the decline as markets are starting to soften and that rate is starting to level out. Inflation and market rate increases help lift the premium, but the growth is now more dependent on operational performance and retention. So you're going to see, again, performance of agencies that were able to manage real organic growth versus riding off of rate. The differential in the value of those agencies are going to get really large, as some agents might not have retained their book at the same rate as others, and they're not going to be able to continue their performance trend without that rate help. So it'll be an interesting to watch what the market does over the next 2 years as it can hopefully continues to soften. And certainly most people believe that it's going to continue to do that. Agencies not growing organically could see that reduced interest or lower valuations in the future without question. That is why if you're an agency owner and you are looking at an acquisition opportunity and their growth rate looks great, their profitability looks great, you look at their retention, their revenue retention looks amazing, but you don't look at their policy retention, you could be missing the fact that you will overpay for an agency because they might have been declining in clients, but growing in revenue, and it actually masks their performance. So savvy buyers know to look for that. Some buyers that are doing this on their own without any advice are going to overpay in this marketplace, unfortunately. Private equity still loves insurance. And there's no two ways around that. They're often looking for tuck-ins for smaller agencies that would not command the same multiples that I just showed you. But that is a strategy now because the middle is shrinking and they're looking to actually fuel their model, continue to fuel their model, and they look for tuck-ins, which would be higher than multiples agency to agency because they're not using bank loans, but it wouldn't be as high as a platform agency. Many PE owners are nearing the end of their investment horizon and will be looking to recap and flip platforms that can drive even more M&A churn and a potential upside for those that are looking to exit, because if you get in here and you get past a recap, your investment grows as they recap as well. So it really is, there's a lot of question marks about how long can this be sustained. I believe that there will be consolidations with those buyers that are super strategic about what they do with the agencies once they get them. Are they putting them all on the same software platform? Are they creating efficiencies inside the agencies that they're adding to their platform, or are they allowing them to all operate separately? We saw a couple of the PE-backed brokers sell recently, and you could see the multiples that they commanded shows the difference between those that consolidate and those that don't. So as you're thinking about selling to a PE-backed broker, your thought may be, I don't want to have to do everything to change. But once you're part of their platform, you want them to be as efficient and profitable, especially if you have stock in that broker. So it's really interesting, the perspective going in and the perspective once you're in there, because it now becomes part of your payout is the stock that you took in that buyer, if that's the structure that you took. So really interesting and something to think about. Banks are definitely leaving the space. You can see in 2024, there were just 10 acquisitions from bank-owned agencies, and they had divested 10 firms as well. So yeah, they used to be a huge player when I first started in the industry. Banks were pretty active in the buying space. And so if this is something that you were thinking of, that pool is shrinking. It's not completely gone, but just know that that's the dynamic that's happening with that kind of buyer. So in 2025 and ahead, it's still a seller's market. There's still plenty of buyers out there that are interested in growing by acquisition. The buyers are definitely not going away. 2025 is expected to match or exceed 2024. The number of people at or approaching retirement age also is staying pretty flat, if not increasing. And there's a lot of agencies that are thinking this could be their high because the market is softening and they don't potentially want to innovate, utilize technology, utilize AI, utilize whatever, and are worried that if they wait another 5 years and they've not hit that curve, they could have gone past their high. So I believe that there are plenty of targets that are here and might be asking themselves, is this my high, based on what's happening in the marketplace and just in our society as a whole, that they think, the way I've always done it might not be the way it's always going to be done. This could be my opportunity. So what can you expect in your agency? I've tried to talk about that this whole time. If you're a platform agency, everything I just said applies to you. If you're an agency that is potentially looking to exit and is interested in a tuck-in, everything I just said applies to you, if you're going to have a cash, stock, and earn out deal. But if you're a smaller agency and you're thinking about your future, you have to ask yourself what's most important to you. Money is not necessarily always what's most important. In fact, we ask agencies that come to us for valuations, what is most important and why are you coming to get the valuation? About 50% of the agencies that reach out to us for evaluation are asking because they desire to transition internally first. And they want to know, is it feasible for me to transition internally? We complete their valuation, tell them what the range of value is that could be supported by a bank loan. And some say, what would it be if I transitioned externally, just so I know the differential? and we can give them an estimate, but there's really no way to know what their agency would command until we take it to market, or until someone takes it to market for them. And sometimes the answer we get is, that's enough money. Like, I'm plenty good with my internal number. It's more important to me to transition internally and give someone else the opportunity that I was given. And therefore, they move forward with a perpetuation plan for an internal transition. Some, the differential is so large that they think, okay, I want to test the market and potentially find a structure that allows them to show their internal people a path forward to having a minority ownership in the agency or the purchasing agency, and also command a higher price that sets them up for their retirement. So it's not a one size fits all, or a I sell or I internal. There's actually buyers out there that let you do a blend of that. So I don't want you to think, again, not all buyers are created equal. Not all structures are the same. And the multiple would be different on a structure like that than it would be on a purely, we're going to buy the entire agency, fold it into our model, and make changes. So your expectation on multiples really highly is determined by what's most important to you as a seller, and your expectation on multiples as a buyer is really dependent on what's most important to that seller and whether or not you have more profitability or less profitability in order to satisfy what they need. So think about the agency deal scenarios, just so you're aware. When agents come to us, the average agency is operating right around a 15% EBITDA on, if that's a lifestyle agency. Our statistic over the last 18 months has actually been a 17% EBITDA. We can typically recast them to about a 30% EBITDA or pro forma EBITDA based on taking out, discretionary spending, whatever that is, changes in staffing, etc. So we can get them to a 30, and the internal valuation multiple typically ranges somewhere between 6 to 8 times EBITDA based on the risk inside that agency. External valuations are somewhere to 7 to 10 times EBITDA. And if you start adding earnouts and etc., that can go all the way up to 12 to 14. High EBITDA margins are with specialty brokers and tuck-in books of business, but the M&A headlines are typically, they're definitely private equity deals. They include a cash, stock, and earnout. They include large performance expectations and profitability goals, and they're not relevant to a lot of small private transactions because there's no way to manage that debt to EBITDA ratio, as well as you may not want to, in the last 3 years of your career, hit double-digit growth. Like, that might not be the structure that you're looking for. So really important to understand what your expectations are based on who you are as a seller and based on who the potential buyers are that you're talking about. It would never be reasonable to think an agency across town would be competing with what private equity backed agencies were, unless that agency across town has more cash on their balance sheet and doesn't have to go to a bank. So it also depends on the size of the deal, whether or not they can get super competitive with those prices and multiples. Important to remind you, as an agency owner and as a buyer, the thing we can manage is the EBITDA or the operating profit. The multiples are dictated by the marketplace and by the risk inside the agency. So I walk around with a hat that says EBITDA on it, which means earnings before interest, taxes, depreciation, and amortization, because I think as a business owner, that's the number you should know. That's the number that you can control. And that's one of the two numbers in the equation that dictates the value of an agency. And the multiple, while it's fun to talk about, it's definitely not the one that you can influence as much as you can influence the first part of this equation. Your growth and profitability are the two biggest factors driving the price of an agency or the value of an agency, followed by followed by the transferability of that agency. So your own risk and how you're performing, and how, if you leave or if a key player on your team leaves, the performance of your agency will continue to operate after that transition. So that transferability thing is something that you could have your head down working in your agency and not really think about it. It's something that we actually highlight what those risks are when we do evaluation of an agency pretty significantly, in order to give you a runway to work on those transferability items. It could be that you don't have any employee contracts in place, and therefore your agency is more at risk of someone leaving and soliciting your customers, where therefore a buyer would be nervous that the retention rate of your agency would not be as secure as an agency that's well protected. It could be your transferability is you use paper, and it's really tough to gain knowledge outside of an agency if everything's in manila folders and paper, or in people's heads, and not in an AMS system where they can access the notes on those clients. So transferability is something that we can influence. You can't get rid of all of that risk, but it is definitely something to think about and be strategic about. One of the transferability things could be you have a large producer that manages some really large accounts. Introducing multiple people into that account to manage it, to build relationships with it, would then make a higher probability when that producer leaves, or that one account manager leaves, that there's multiple relationships, and that customer would be less likely to leave because they know more people or the team of people helping them, rather than keeping that such a siloed relationship. So with owners in particular, making sure that they start transitioning those relationships early, especially if there's large accounts in the agency, really impacts their transferability and that risk, and mitigates it significantly. So I said before, setting the expectations about what you and your agency can expect about multiples really starts with what's most important to you. If the number one thing that is most important to you is true, and is what the answer that I get most often when I ask our customers this, they typically say, what's most important to me at the time when I'm going to no longer be the owner of this agency, I want to take care of three things. I want to take care of the people that helped me get here. So I want my staff well taken care of. I want to take care of my customers and make sure that when I live in that community and I run into people, they're still being well taken care of after I'm gone. And number three, I want to take care of my family. I want to get a fair price for my agency. That's typically the answer that I get. And if that's true, then from there, you can sort the buyer options that you have, and do they actually match with your priorities? If you say, I want the name on the door to stay the same, I want the location to be exactly where it is in the community, and I want that presence to continue. I want my staff to all have the positions they have right now. I want the culture of my agency to remain untouched. I want my customers to have the same experience. Well, you just said the location has to stay, the name has to stay, the experience has to stay, no changes in your staff. That limits the amount of profitability you can expect, therefore will lower your price. But if you said, I'm okay if the location changes, I'm okay if maybe you have to make some transitions in the staff, I'm okay if you change my name, change the systems we use, change the whatever, as long as my customers are well taken care of and my key employees that got me here and can provide continuity have a place, then you have a different approach to it than someone who doesn't, and you should not expect the same thing. You should expect different things based on what the requirements you're putting on a potential seller or potential buyer. The number one thing on this sheet, though, or on this slide, that I think is underestimated is a person that has owned an agency and been their own boss for 40 plus years or 30 plus years or however long it is. The thought of working for someone else seems like it's a doable thing until it isn't. So I think it's the most underestimated part of all of this. We all talk about these multiples, but the reality is to command some of the multiples that we're talking about, you have to be willing to work in a very different environment for another person for a period of time to get those earnouts and actually achieve that overall multiple that you see in the headlines. If you're not willing to do that, then don't even put yourself in the position to have that expectation about multiples. Some people say, when I sell my agency, I want to retire. Like, I want to be done and let somebody else take it from here. That would mean you don't commanding an earnout, and that part of the multiples that gets reported, eliminate it, because that's not part of your deal. So I think being really honest with yourself about where you are and what your expectations are and where you are in your career and what's most important to you really helps set the expectations, rather than listening to what so-and-so did or reading it in an article or whatever. Those are their situations and they aren't always transferable. So there's different types of options. An internal sale can be a sale with a bank loan. It could be an inheritance. It can be gifting. It could also be an ESOP, which is for very large agencies that have a really healthy makeup. Internal is typically by an acquisition of either an agency nearby or a private equity backed buyer, or potentially a bank, I guess. Those are the different types of options when we just get really, really clean and easy about it. In those options, there are pros and cons. The internal can, have continuity in the culture, continuity in your staff. They could have family, multi-generational family relationships maintained. You have a presence in the community. Very little things actually change about the agency potentially in an internal transaction, and there's a lot of continuity. The con is the next generation might not necessarily be able to be able to run the agency. You might not be able to get the funding based on paying the current owner and the future owner. The profits could be actually less. Therefore, it's difficult to command anywhere near the price that the exiting owner needs. As long as if they stay there and they're commanding a salary and a payout for their agency, it becomes very difficult. They might have a hard time coming up with a down payment because they don't have piles of cash laying around. So if they want to use a bank loan, we'll have to discount the agency in order to get a bank loan because they don't have the down payment for the 20% down. And do you have the right talent and expertise to run the agency and command the performance to satisfy the loan of the exiting owner? Even if it's an owner finance note, you have to place your trust in the future owners of that agency, especially if it's an owner finance deal, which happens often, especially in family transactions. And what occurs is the price is set based on what other people have done, and it's an unrealistic price based on your situation. Number two, the future owner maybe doesn't have the same breadth of knowledge or experience to command the performance that's needed, so the performance doesn't show up. And you've set too high of a price, the performance doesn't command the results, and you have to renegotiate the deal. That makes for a really bad Thanksgiving dinner. So that's what that means by 40% actually survive and don't need to be renegotiated. And sometimes they actually can hurt the performance of the agency pretty significantly. So those are the cons, but there are a lot of pros. External transactions, there are pros and cons. Typically, it's a higher price for the current owner. There are some economies of scale when you bring two agencies together. Two locations becomes one. Two systems now become one AMS system. Two sets of books now is one set of book. Well, maybe two accountants, now you have one. So there's definitely reduction in expenses. Your E&O coverage is combined, et cetera. And you have potential for more robust infrastructure and resources. You might have the strongest bench you've ever had when you take both of your teams and put it together. Or you might have two agencies that are both staffed the same way, where every one of the producers is at or nearing retirement age, and you put them together and you just exacerbated the challenge and the continuity or the expected ongoing performance of that agency without even realizing it. While you have people, they're all going to retire at the same time, and that creates a future problem for that combined entity that's even bigger than it was from the first place. So you got to be really smart about, does a potential acquisition strengthen me or actually increase my weaknesses significantly? The cons in an external transition is you're taking two cultures and trying to blend them. That always takes more time and effort than you expect it to. Definitely, you might lose staff because as you change the culture and change the expectations, you could lose staff or have people that don't transition well in that change. Customers might feel the same thing. They might have always loved the way that the agency that is exiting did it, and not like the structure or the engagement that they get in the new structure. So retention, it typically tends to be a bit lower in an external transition than it is in an internal. Not always, but that's pretty likely. The carriers might actually get squeamish with and might not translate from one agency to another. It used to be you could acquire in order to get carrier appointments, but in this hard market, it's actually been an opportunity for carriers to say, we're not going to extend. In fact, we're going to cancel that contract. You just gave us a reason why, because it's uncertainty, and we're going to choose to pull our contract. Potential reduction in loss in retention. We already talked about that. Loss of connection and working for a different company becomes a factor here if you're going to stay and work for a period of time. So there's definite pros and cons in each of these structures. You need to be aware of what those are and really think about what your appetite is for each of the concessions, while you're giving up some things in order to maybe make up some differences over here, and really comes down to what is most important to you. The synergies between two agencies or a buyer and a seller are really important, whether you're on the buying side or the selling side, and really thinking about, what do I have to offer that is most important to the seller, and what positions me to be the strongest buyer in this situation. And listening to what is most important to them is probably key here. Like, there are things that happen based on your network relationships, your carrier, your geographic location, etc. But in some cases, it's really just culture. Like, really, how do we operate? How do we deal with our clients? How do we deal with our staff? Are we, really, really high expectations and a hunter environment? Are we more farmers and we catch the leads and write the thing and, want to have a more passive approach to growth? Really important to understand that. But the economies of scale are typically come from your carrier overlap. You're now able to command more contingencies together than you were separate. Your staff and talent overlap is people acquire for talent all the time, because that is really difficult to come by. And you got to believe, though, you got to get to know that talent and make sure that someone else's superstar might be a C player for you. But that is 100% a reason and a win in an acquisition. Sometimes, combining your technology and leveraging another agency's strong technology infrastructure can then allow you to become more efficient in what you're doing. The resources you have from a network affiliation, or the resources you have on your team. You might have two operations people and now only need one, etc. So there's lots of synergies to consider. And when you're making an offer, really estimating those synergies, you need some outside guidance on that. You can very easily miss something if you are not well versed in how to think about those adjustments and think about that ongoing operation of two entities. The biggest thing here is multiples are published all the time. And I would tell you the only multiple that's relevant is the one that makes sense with the things that are important to you as a seller, And the only multiple that's important to you if you're a buyer is what that seller finds the most value in. So don't think you can't compete. There are plenty of people out there that are interested in finding a buyer that looks and feels like them, that creates the same culture as them, and creates the same environment for their people, whether that be their staff, their customers, and allows them to get a fair price for their agency. So many agencies are contemplating today if this is their high. If you are looking to grow by acquisition, I'd say you're in a position of strength, but you need to A, make sure they know that you're interested, B, be able to find the right fit and listen to what's most important to them, and then meet them in the marketplace where it makes the most sense with confidence that, you know, you're really not competing with the multiples in the headlines. You might be competing with other agencies that can give them a multiple that's reasonable. So for more information about how to make these kinds of determinations, what to think about multiples, how to assess an acquisition opportunity, or how to position yourself to maximize your own value, that is what we do. We're partnered with Louisiana to provide those kinds of resources to you. You can schedule a call with anybody on our team and we can talk about that individually with you. But I strongly recommend getting yourself well positioned far before you ever think you're going to do something. It puts you in a position of strength. I hope learning a little bit about multiples will incite you or maybe make you take some action that you didn't do before. So, all right, Carson, thank you for having me.